Okay, good morning, everyone. Good morning. How are you? So today we're going to be talking about corporate performance and how we analyze corporate performance. The nickname for this lecture would be ratio analysis. So what we are going to be doing is going through quite a few ratios. We're going to discuss which ones we should be using, what they're useful for, and then we're going to select the best ones and group them together into a couple of tools that we can use to have an overall picture of how the company is performing. So to start with, as in every lecture, we're going to go through the objectives and the sort of things that you should know after finishing this week. So basically, we're introducing the concept of corporate performance analysis. You should be able to identify financial statements, know them upside down and inside out. Explain the effects of different accounting policies. We're going to focus on some of them today. Calculate different types of ratios: profitability, efficiency, leverage, liquidity, and market ratios. So every time you get into the literature for ratios, there's so many of them, right? And people call them different names, and they make slight changes. We try to get the list down as much as we possibly could, and I'm going to be highlighting the ones I think are the most useful ones for you. So finally, we're going to look at how we look at trend analysis, how we look at profitability using growth rates, and finalize with two groups of ratios: DuPont model and an alternative, which is the ROIC tree analysis. So that is what we're going to be doing today. So what are the main uses of financial statements? There's a list there going from customers, suppliers, people who provide, and companies who provide finance, and employees. I would definitely say the main focus is on these guys. These are the main guys who are interested in looking at the financial statements of a company, right? It's those investing in the company, either via debt instruments or via equity instruments or hybrids, because you can also invest in debt instruments that will eventually convert into equity instruments. Not to mention that, not to say that the other ones are not interested, but I haven't seen that many employees looking at the financial statements of the company on a quarterly basis. They would look at a summary, read a few news articles, and that would pretty much be it. But the ones looking really in depth would be these guys here, and suppliers when they're supplying things in the long term, right? If you're getting in a big contract, supplying contract with a company, you want to understand what's the financial situation of the company and whether the company is going to be able to pay what they're saying they have to pay. So next week you will have to discuss a question on why earnings management occur and why would management have an incentive to either maximize or minimize reported earnings, right? Because one thing we need to understand when we are doing financial analysis is that there's motivations for people putting these documents together to most of the time be transparent and abide by the laws, but then they have incentives to make money, meet targets, meet contractual clauses, and so on and so forth. And many of these situations create incentives to slightly change the way you report things in order to either look better or look worse than what you actually do. Many of those changes could be within the realm of what is legal. Changing accounting policies is something that is legal. But sometimes there could be things that are not so much. Let me just very quickly show you an article. This is 2016, discussing Dick Smith and how they use the suppliers' rebates. Have you heard about this? Anyone? Yeah? Do you want to brief us? Or give us?
No, I don't know too much about it. I just remember hearing
Okay.
about Dick Smith being in trouble.
Yeah. Anyone else who heard about it and what it was about? So basically what they were getting is, by buying products from suppliers, they would get a rebate after selling the products, right? So what Dick Smith was doing was they were recognizing those rebates before selling the products, right? So they were recognizing a revenue, right, that they haven't yet got. So they were, and in many cases, they didn't even sell the products in the end, but they still recognized the revenue. And that changed the bottom line of Dick Smith from 100 and something million loss to profit, right? So it wasn't just a small thing, it was the difference between losing money and making money for shareholders. So we will discuss earnings management in more detail later on, but that is just to show you, give you a taste for reasons why management may want to maximize earnings in this case. So financial statements we will be working with: statement of earnings or income statement, financial position or balance sheet. Those would be the two main things we're going to be looking at, right? How much the company sells, how much of that is left to shareholders, and what does the company own, and what does the company owe to sources of financing. That is the balance sheet, right? So those are the two main things we're going to be looking at. And if you have enough information from those two financial statements and the notes, you can calculate yourself the cash flows, which we're going to do. So this statement of cash flows is something that you have in the financial statements, but we will recalculate our own cash flow statements because we want them to look in a specific way for our valuations. Statement of changes in equity, and finally the footnotes. I would say out of these 5 elements that you see there, the top 2 and the bottom one are the ones you're going to look in greater depth. Statement of earnings or income statement, financial position or balance sheet, and the footnotes. Footnotes are usually not read in great detail, but that is where you get all those little stars. When you don't understand something in the financial statements, there's usually a little number there that if you follow it, there's a footnote that gives you additional detail. And we will discuss later on in the term the quality of financial statements. And one good sign of quality is that whenever you have a question looking at the financial statements, you're going to see a little number referring you to a note, and then when you go to the note, you go, oh, okay, now that makes sense, okay? So what do we need to consider when we look at the financial statements? Mainly, we need to understand that all the information there, or I would say more than 95% of the information is historical. So you're looking at what happened in the past year compared in many cases to what happened in the previous 12 months. Okay? So that's the main thing. Why do I say that not 100% of the information is historical? Well, you have information about management's prospects and what they think the future of the company would look like. And different companies would do this differently, but in all of them you will have some sort of idea given by management on this is where we're heading, this is how we're doing things. Another thing that we need to consider is that financial statements are subject to accounting principles. And here we name a few things that could change within things that are legal. And that is, how do you calculate or value inventory, for instance? We will see a short example in the next slide. How do you do purchase accounting? How do you do revenue recognition? We just talked about Dick Smith and an example of revenue recognition that was pretty dodgy. Recognizing as revenue something that they still haven't sold. And also lease accounting, right? In lease accounting, you, for instance, have the option to do accounting of leases, capital accounting or capital leases or operating leases. What's the main difference between the two? So an operating lease is only affecting the income statement, right? Because you're only recognizing the payments you're doing as a lease. Whereas if you have a capital lease, you are taking ownership of the asset, right? So it has an impact on your balance sheet. Whereas in the operating lease, the assets never touch your balance sheet, because this is something that does not belong to the company, it belongs to someone else, and we're just leasing it and paying these amounts. So the only impact of operating leases would be on the income statement. You also have to understand that results may be affected by seasonality. This will be more evident in some industries than others, and I would add to this that seasonality could also be economic cycles. So here we're saying holidays as an example, right? Which is something that would happen every year. But then you have economic cycles, and you have industries and companies that are pro-cyclical. So when the economy is booming, they're doing great, and when the economy is down, they do the same. And there's not that many, but there's quite a few industries that are going in an opposite direction as the economic cycle. So they're doing great when the economy is doing badly, right? And you can think about places where you sell stuff from people who don't have enough money to repay their debts, right? Any like pawn shops and all these things are things that do better when the economy is doing worse. Because people need to get rid of things, so they buy stuff very cheaply, and they can stock it and then sell it at a later date. Let's have a look at how a difference in how we account for inventory has an impact on profits. So, first column, we have a description of what we are doing, right? If I can show this. Second column, we have first in, first out as one of the options to recognize inventory. The third column is last in, first out. And the last column, we're looking at the average cost using both. But we're going to focus mostly on the first in, first out, and last in, first out. So what happens with this company? Let's assume this is a company that is only starting today, and they buy first product, 10 units at $10. So that costs them $100, regardless of the inventory accounting policy. Then they buy another one, another batch of 10 units at $15, right? So everything is the same for both cases. In both cases, total inventory is valued at $250. So if next the company sells 10 of the units at $25 each, they will get revenue for $250, right? But before doing that, let's see what happens with inventory. If you're in a first in, first out world, the first units you're selling, you're recognizing are these guys here, right? So the way you're valuing your goods sold is we sold the guys that cost us $100. Whereas in the last in, first out, we are recognizing that same sale and that the cost of that sale was not $100, but it was $150. Okay? So what that will do is that the remaining inventory will be 150 in, first out, and 100 in the other case. Revenue will be the same, $250, selling the 10 items at $25 each. Cost of goods sold would be different, depending on how we recognize inventory. And therefore, profit will also be different. Why do we need to understand this? The main reason to pay attention to this is if you're comparing firms, right? And when you're comparing multiple firms where inventory could be a big deal, you have to make sure that they both account for inventory the same way. And if it's not, comparability will not be great, especially if there's inflation in the economy where you're looking at the firms, right? Because if there's inflation, there's more changes in prices, and the more variable prices are, the more relevant the inventory accounting policy is. And the other situation in which you want to have a good look at the accounting policy for inventory is when companies make a change. So if you're looking at consecutive years for a company and they made a change in accounting policies between one year and the next, comparability in that time series will be affected. That doesn't mean you're not going to do any analysis. What you need to make sure is that you can redo the ratios to reflect that change. So you'll have to make a little bit more work. Any questions so far? Okay. So basically, this slide is discussing how different accounting policies have an impact on how we value inventories, but also what sort of impact that has in profit recognition. So one of the questions you have for next week is exactly looking at how inventory accounting, what would you prefer in an inflationary context? We'll discuss that next week. Okay, let's jump into the long list of ratios. So we're classifying ratios into 5 groups. Right? We're talking about profitability, efficiency, leverage, liquidity, and capital market. Out of these, by far, the top 2 are the ones you want to understand when you're looking at an industry and comparing firms within an industry. These are the two main ways of making money. How do companies make money? Mainly with operations, either having high profit margins or having high turnovers, right? So the first one is looking at profit margins, and the second group is looking at efficiency and turnover. If you can have extremely high turnover with high profit margins, it's the best of the world. That doesn't usually happen. So we will go through each of these groups, starting with profitability ratios. 2 ways of looking at profitability. We can look at profitability within the income statement, or we can look at profitability on the use of our resources. So that is profitability mixing income statement and balance sheet figures. I'll come back to that in a minute. So this first profitability ratio, return on sales, what it's measuring is the efficiency with which the company turns each dollar of sales, of revenue, into how many cents of profit to shareholders, right? So this is doing bottom line of the income statement divided by the top line, right? So what's in between these two things? You have the cost of goods sold, you have all your general admin, marketing expenses, you have depreciation, you have amortization, you have income, interest income, you have interest expenses, you have taxes, others, and so on and so forth, right? So after paying all those expenses with your revenue, you get a net income, and if you divide that by the top line, you're getting how many cents is the company making for shareholders per dollar of revenue. Most ratios won't have a threshold, so I wouldn't say this is good if it's below or above this number, but most of them, they have a clear direction. And the direction that you want to be in this one is the higher the better, right? The higher the better. The higher the net profit margin, the better. So if you can make this 40%, what this means is that for each dollar you're selling, 40 cents are made for the shareholders. If this is 2%, what that means is that in order to get $2 in the pocket of your investors, you have to sell $100, right? So the higher, the better. Each industry may have a different average. This is what I was saying before. There's no such thing as, oh, you're doing 20%, you're doing great. 20% may be great in some industries, and it may be rubbish in other industries. Right? Largely depends on how intensive in capital the industry is, right? You have capital intensive as opposed to labor intensive industries or companies. And that will definitely have an impact, as well as this will vary with the business cycle. You would expect in booming economies to have higher margins, in recession, these net profit margins to go down. Just think about this for your, especially for, you may do some of it for your first part of the assignment, but definitely you will do it for the second part of the assignment. Just reporting something as 5% is not enough information. But if you see 5% this year and you're comparing it to what happened in the last 3 years for the same company, you can provide more insights. If you put a little bit of context to that by showing what's happening with other companies in the same industry, you're just providing even more insights. And if you understand the underlying reasons why the changes occurred, you're providing even more insights. So if you're saying net profit margins have been decreasing because of increased regulation in the industry, and the regulation that changed was this, and this is the sort of impact that it has in the company, that is providing insights to your investors. It's not just saying this is 5% and it used to be 8%. Other profitability ratios. So we went bottom to top, and now we're just going up. So what we're looking at here is gross profit to net sales, or operating profit to net sales. I won't stop in those two. I will jump to the next slide where we have EBIT to sales and EBITDA to sales. So that's earnings before interest and taxes, and earnings before interest, taxes, depreciation, and amortization. So what this is telling us is how many cents of earnings is the company generating at the operational level per dollar of revenue. In these profitability ratios, everything is based on a per dollar of sales or revenue. A slightly cleaner version of the EBIT to sales would be the EBITDA to sales. And the reason why I say it's cleaner is because it's using earnings before interest taxes. So it's ignoring the financial structure of the company. It's only looking at operations. But it's also excluding depreciation and amortization. So in that case, what you're doing is, if you have two different companies that one is doing capital leases and the other one is doing operating leases, you will be netting that, and that won't have an effect in that ratio. But again, same logic as before, we're looking at how many cents are left per dollar of sales. Let's look at some questions. So you have 3 chances to win Tim Tams today. Let's do this as quickly as we can. So today I only have, I think it's 1 original and 2 double coats. Tough choice, because I think double coat are much better, but there's only 9 of them, right? So, tough decision. Ten seconds. 5. Pauline. So we see. Does seem to make sense. So it's only the lease payments that you record when you're doing operating leases. that? Hey, originals or double coats? Double coat, good. Is there a pot there? Yeah. Hello, mate. Yeah. Give it up. Okay. So something we're going to be doing next week, when you're looking at profitability, you're not only looking at one period, but you're also looking at how things evolve. And by that is we're measuring time series, we're doing time series analysis, so we're looking at the rate of change of these things. How are revenues changing? How are expenses changing year on year? How is the bottom line, the net income, changing year on year? Is it improving? Is it getting worse? When you look at a company and all its business units, can you break down these changes by business unit? Are there business units that are not only contributing more to the business, but also increasingly providing more revenue/profit to the business? One thing you have to be very careful when you're looking at growth rates is you're looking across financial years, right? And in these financial statements for consecutive financial years, there may be acquisitions, right? So if that's the case, just think about a grocery store chain, right? That they have 100 stores, and from one year to the next, they buy a competitor with 15 stores. So if you look at revenue, and you only look at total revenue, you know that the change from one year to the other will have basically two impacts. It'll have the organic increase or decrease in revenue with the existing stores, and it will have an increase revenue coming from the new stores. So one look at solving this is looking at only the revenue change for the same stores. So if you have information that is granular enough, and you have information for the 100 stores that the company had last year, you will compare those. Or alternatively, what you could do is compare revenues per store, right? Revenue per store is a measure you can compare across years, regardless of how many stores the company has. Okay? And that could potentially give you answers to the question, is the acquisition strategy working? Are we really selling more per store or the same per store, or we are just becoming bigger and bigger and bigger, but we are selling less per store? So that would definitely help you analyze whether the acquisition strategy of the company makes sense or not. Another thing you have to bear in mind is inflation and its impact in growth rates. You know that, again, any increase in revenues will have an impact of genuine increase in revenue via selling more units, but there will be also an impact of changes in prices due to inflation. Okay? So you have to make sure that when you're comparing, you will either use nominal growth rates or real growth rates consistently. For all firms you're comparing, you're doing the same thing. The main difference between one and the other is that nominals include the impact of inflation. Nominal is whatever you see out there, where everything is impounded into that revenue number. And the real ones would be once you take out the impact of inflation. This shouldn't be a big impact in most cases, but it could be relevant in other contexts of higher inflation than the one we most of the time see here. So profitability can be related to any variable. And so far we've looked at profitability within the income statement, how many dollars we're getting to shareholders for each dollar of sales. But you can look at our return on assets or our return on equity. So when you're looking at these guys here, these two top guys here, that ratio is using a variable from the income statement. That could be net income. And you're using a variable or an item from the balance sheet, total assets or shareholders' equity. Okay? So if we do return on equity as net income divided by shareholders' equity, what does that mean? What do we compare that with? Say return on equity is 15%. So return on equity of 15%, what it's telling us is that during that year, the company generated 15 cents to shareholders for every dollar shareholders invested in the firm, right? So who has calculated cost of equity using CAPM before? Capital asset pricing model. Okay. You did and then you didn't? Okay, so you will compare your return on equity, and we will come back to that, don't worry, with the expected return equity holders have, right? So you as an equity holder, when you invest in a company, you go, well, I would be happy if on an annual basis, I get back 10% or 15% return on my investment, right? And you're going to compare that to alternative investments, like putting your money in the bank, buying bonds, buying this, buying that. Your return on equity, you're going to compare to that expected return, okay? And you will know investors will be happy if your return on equity is equal or higher than their expected return, right? If investors are expecting 12% per annum and the company generates 15, that means we're exceeding investors' expectations. The only thing, and we will come back to that later in the term, is that the expected return on equity is not something that is easily observable. It's not that your shareholders tell you, oh, we want this return, right? It's very easy to observe from debt holders, because when you borrow money, you have a cost of debt that is very clear and explicit, but it's not the same with shareholders' equity. So I would definitely focus on these two as two ways of measuring how the company did this year in terms of generating return for shareholders and debt holders as a whole. Return on sales, we already saw, but you can also measure return per employee, per location, per store. So out of this slide here, I would definitely highlight the return on assets and return on equity, and we'll come back to them when we do DuPont and ROIC analysis in a few minutes. So this is a question you have for next week's tutorial. I will skip it now. So second set of ratios. We've looked at profitability within the income statement and across the income statement and the balance sheet. Now we need to see how efficient the firm is in managing the assets. Number one ratio of the efficiency group would be total asset turnover. So this is taking the top line of the income statement and dividing it by the left-hand side of the balance sheet, right? The total of assets that are under management. This can be any number. This can be any number, and it would largely depend on whether the company is capital intensive or labor intensive. You would expect capital intensive firms to have larger assets, so this ratio will tend to be lower for them. And companies that are labor intensive, that don't have such massive need for assets, so these companies will tend to have higher turnover ratios. People get confused with this ratio. The way we usually look at this is, so we say, how many times in the year we sell our total assets, right? So a company with 100 million in assets and 100 million in revenue, they're selling the total assets once a year, right? Does that mean you're selling all your assets? Clearly not. You're not selling your property, plant, and equipment. This is only a way of saying, it's not how many times we're selling our assets, it's how many times we're selling the amount of money we have invested in assets, right? So this ratio, in most cases, I would say the higher the better, right? The more turnover you have, the better. Because that means that you are using your assets more efficiently. Why do you have assets in your company? You have assets in your company to sell whatever you sell and make money, right? So the more you sell per dollar of assets invested, the better you're doing. Except if what? Is always selling more better? Can you think of situations in which selling more is not necessarily better? What happens if you sell at a loss? If you're selling at a loss, the more you sell, the worse off you are, correct? So high asset turnover is a good thing, provided that the company is profitable doing what they do. So this is the bigger picture in terms of looking at asset efficiency, asset use efficiency. So the main question here is you're using net sales, income statement, total assets, balance sheet. Two completely different statements, right? Income statement resets every year and starts from zero. Balance sheet is an accumulated figure, right? So when you have your assets, at any point in time, even if you have a quarterly report, assets reported there is whatever the company has. Whereas if you're looking at an income statement and it's a quarterly report, you will only have figures for that quarter. So the reason why I'm mentioning this here is because in the same ratio we have two things. One that is a flow. This flows throughout the year. And this is a stock, right? So this is, each year you have an amount of assets. So when you're calculating this ratio, you have basically three main options with your assets. You can use assets at the beginning of the period, assets at the end of the period, or the average, right? So that is this comment here. Is if they're stable, you can use year end. If they're not stable, you may need to use an average, right? So if there's a fluctuation of 20% in your total assets between last year and this year, you're better off using an average than using the end of the financial year number. And as I said before, this will largely depend on how capital or labor intensive the industry is. So when you see, yeah, boring, right? When you look at total asset turnover, you can see that as 0.8 or 80%, or 1.2 or 120%. You can see them either way. So going to specific parts of the assets and liabilities, we're going to look at three sets of ratios. First one related to inventory. And we can look at the efficiency on how the company deals with inventory in two ways. We can look at the turnover, right? So when we look at turnover, we're looking at how many times during the year we sell our inventory. Do we sell it 3 times? Do we sell it 4 times? Do we sell it 5 times? So on and so forth. Or we can see the same looking at days of inventory, which is the inverse of the other one, right? So let me do a very simple example. If your inventory turnover is 2, right? So that means you're holding your inventory on average 181 days or 82 days, okay? Because you're selling them twice a year, so that means that on average it takes you 180 something days to sell them. So these two, which one you use largely depends on what you understand better, right? I quite like days of inventory, and I will come back to that when I show you the other ones, because when you're looking at trying to understand how the company manages the working capital, understanding these figures in terms of days there's a graphical description of that I feel comfortable with, but by all means you can use any of these. I wouldn't report both consistently, I would go with one and just make mention to the other. So this means, so if this is 2, that means that on average they're holding stock for 180 something days. What else do we need to say? Well, you're definitely going to be comparing this to the industry average and competitors, and also within the industry over time, right? You want to understand how the inventory policy is changing, how they're becoming more or less efficient, and definitely looking at how inventory is valued, first in, first out, last in, first out, will definitely have an impact on this. So you have to be aware of any changes when you're analyzing this. If the inventory changes a lot during the year, you're better off using an average, right? And you also have to be very careful, because sometimes companies do things to try and lower inventory at the very end of the year, just to look better. And that you can do 1 or 2 years in a row, but it's very hard to do consistently. So continuing with this, just think while we're going through this next slide and the following one, we're looking at the day-to-day operations of the firm. This is how the company manages what they have in stock. In the next slide, we're looking at how the company manages getting paid for what they sell. Right? So this is exactly at the core of the operations of the business. So we're looking at the turnover of accounts receivable. And we can look at this as net sales divided by accounts receivable in our balance sheet, or we can look at it as accounts receivable divided by net sales times 365. So what this is telling you is, on average, how many days is taking this company to collect the money for their sales. You would expect companies selling cash, retail chains that will have lots of their sales based in cash, to have very short periods or account receivable periods. And you would expect companies financing the buyers for 3 to 6 months to have longer receivable periods. And the reason why this is so important is because if your receivable periods is very long, in order to continue operating, you will have to get financing to continue your operations, right? Because if you have to wait for 6 months to get paid and you want to continue operating, you will have to get money from somewhere. Finally, we can look at the main operating liability, which is payables to suppliers. And we can look at it from a turnover perspective, or we can look at the period of accounts payable. So if we are focusing on the payables payment period, what that is telling me is, on average, how long does the company have to pay its suppliers for the goods and services we are buying from them? Happy to take questions. Good? Yeah, excellent. So let me go back one slide. If you get these days here, how long does it take a company to sell the inventory? And you add to that number of days, how long does it take the company to get paid for it? That is how long it takes in total for the company to get money in the pocket for the things they're selling, right? So that's one period we're looking at. And the other period we're looking at is, how long do we have until we have to pay our suppliers, right? Most companies, the first two added together are a longer period than this period here. And what that creates is a need to invest in the working capital of the firm. So the concept of working capital is the difference between the first two minus the second. And whenever you have a gap in there, that means the company has to get financing to continue operating. Okay. Second set of questions so that you can wake up. Seconds. Five. One more. rates remove inflation? Yeah, capital-intensive industries tend to have more assets, so you will have lower. So I saw one number 2 to win. Come on, Conrad. Who's the winner? You are? Originals or double coats? Ah? What was that? There you go. Well done. Yeah. Okay. Let's quickly jump to financial leverage. So far we looked at how the company makes money either by being profitable in each single transaction or by getting as many transactions as possible. Another way in which a company can save money or make money is via leverage. All right, much better. So how does a company save money via leverage? Anyone? Tax deductibility of interest payments. So if a company has debt in its capital structure, that debt, the company pays interests. Those interests are expenses that are deducted from the revenue of the company. So the company will pay less taxes. Okay? So that's one of the main reasons, if not the main reason, why companies take debt. The other reason is cost of debt is usually lower than the cost of equity, and it helps companies grow. However, when we're analyzing companies, we need to understand whether the level at which the company is levered, it makes sense, right? Or is it too much? So when we're looking at financial leverage ratios, we are also looking at coverage, at how well is the company doing in terms of repaying the costs of the debt. But we're going to start with the first leverage ratio, which is called financial leverage. This is actually something we're going to use in DuPont. So we're doing assets divided by shareholders' equity. Right? So this should clearly be 1 if the company has no debt. Right? If a company is entirely financed by equity, this number will be 1. And this number would be higher than 1 as the company has liabilities, such as debt. So the higher the ratio, the higher the leverage, because that means a higher proportion of the assets are financed by debt. This is quite an unusual way of looking at leverage. It's usually easier to understand when you look at it from this other perspective. And let me focus on the bottom one, where what you're doing is you're looking at your long-term debt divided by the sum of your long-term debt and the equity. So what we're doing there is we're saying, out of all the long-term financing we get from credit holders and equity holders, this percentage belongs to the debt holders. So if this ratio is 40%, that means that for each dollar invested in the company, 40 cents are provided by debt holders and 60 cents are provided by equity holders. Okay? But as you can see, ratios you can calculate in as many ways as you may want. When we look at DuPont, we're going to look at these assets here, and we're going to show that there's some reasons why you wouldn't want to use assets on the bottom side of that ratio. But I'll come back to that in a few minutes. So in looking at financial leverage, we are looking at the leverage itself, as I said before, but we're also looking at coverage. Focus on EBIT coverage. So this is earnings before interest taxes divided by interest expense. You would expect this to be higher than 1, correct? If this is less than 1, that means the company is not generating enough profit to pay for interest expenses. Right? Someone could say, well, we could, instead of using EBIT, use EBITDA, because in reality, depreciation and amortization are not cash expenses. So we still have that money to potentially pay for interests. And that's a fair point. And that's the reason why we have here this cash flow coverage, which is EBIT plus depreciation, so we add back depreciations. So when you take debt, in some cases, lenders will have covenants saying you have to meet these targets in order for our contract to remain the way it is. And some of those covenants will refer you to a minimum coverage the company has to have. So I would say your coverage could never go below 3.5. Right? So in any single year, your profits should be at least 3.5 times higher than the interest payments. If you go below that threshold, we'll have to sit and talk and see how we change our contract. So the bottom of these ratios, the debt service coverage, is not only looking at the interest payments from debt, but it's also looking at interest plus the principal payments, right? So that debt service coverage is not only measuring whether the company has enough profit to pay interests, but also whether it has enough money to repay the principal. If you look at these two ratios for any company, your debt service coverage will always be lower than the other one, right? Because in the debt service coverage, you are including an additional cost, which is the principal repayment. Liquidity ratios. We're focusing on two of them, current ratio and the acid test ratio, or quick ratio. What this is looking at is current ratio is dividing your current assets to your current liabilities. It's looking to see if the company has enough solvency to repay the short-term liabilities with the short-term assets, right? So if the company stops operating and has to sell all the current assets, would the company get enough money to repay the current liabilities? Yes, no. Or how many times? Is this 2.5? So as you can think, as you would agree, I think, this is one of those ratios that not necessarily always the higher is the better, right? Because if you're a supplier of this company, you would definitely want to have this as high as possible, right? Higher current ratio means I'm safe, these guys will definitely pay back, right? However, if you're an investor in this company, you want that ratio to be as slim as possible, right? Because the higher this ratio, the more money you are investing in assets that you don't need to have sitting there, right? Because you can always go to your suppliers and buy more. So you don't want to be sitting on a lot of stock or unpaid sales. You definitely want to have that very slim. Enough to keep suppliers happy, debt holders happy, but slim enough so that we are making good, efficient use of our resources. So when you're trying to make an even more take a tighter measure of solvency, you can go down the acid test path, which is removing those current assets that are less liquid, right? So instead of using current assets divided by current liabilities, what you're doing is I'm subtracting from my current assets inventories. Why is that? Well, because those are the guys that will take longer into, because when I have something as inventory, I still have to sell it and get paid for it, right? So it takes a long time for that to turn into cash. So if we remove those from the current ratio, you get your acid test. And if you go to the extreme, you could be trying to measure what is the cash and marketable securities. This is very liquid because it's either cash in hand or money in the bank, plus payables in the next 30 to 60 days divided by current liabilities. So this is telling us, does the company have enough money to promptly go back to suppliers and pay for all the liabilities? That is all we're going to say for liquidity ratios. Final set of ratios is capital market ratios. Two very well-known ones, earnings per share. So that is the bottom line of your income statement divided by the number of shares. I wouldn't even call that a ratio. Definitely a ratio is the price earnings. Price earnings ratio, and we will come back to this, measures brings a new dimension to this analysis. Because so far we've been using measures from the income statement and the balance sheet. Whereas when you do a price-earnings ratio, the earnings per share are coming from the income statement, because it's your net income divided by the number of shares outstanding. But where is price coming from? So price is coming from, this is for public companies, companies that are traded in exchanges. And that price is the price per share in the market. So it's not coming from the income statement, it's not coming from the balance sheet. It is at the close of one day, what is the average price investors are willing to pay for a share of this company? And when you do a price earnings, what you're doing is, what are investors willing to pay divided by the earnings they get per annum, right? So if this ratio is 8, what this is telling us is that investors are willing to pay 8 times the annual earnings as price for the shares of the company. We'll come back to that later in the term. So that's all I'm going to say for it for now on that topic. And a few other ones. You're looking at market price instead of on earnings per share. You do it on EBIT, on EBITDA, on sales, on cash flow. You can look at the market to book value. What is the value the market is assigning to a company's shares compared to what's the book value in your balance sheet? So all these ratios we will come back to when we do market or comparables valuation. So I will just leave them there and we'll come back to them later in the term. So now what we're going to do is we're going to look at 2 sets of ratios. Because the main thing you need to understand when you're doing ratio analysis is you need to have a good understanding of what the company's strategy is. What is it that they're trying to do? How do you make money in this industry? Where's the industry going? Is this research and development intensive? Is this capital intensive? How is it that you make money? You need to understand the current financial statements, and the sort of analysis you will do with the ratios we just saw is you're going to look back 3 to 5 years, and you're going to say, after looking at all these ratios for this company, we understand that this company is doing blah, is healthy in generating profits, but compared to the average of the industry, it doesn't have as much turnover, so they could definitely improve in the efficiency on how they manage their assets, and so on and so forth. So when you finish doing your financial analysis, you should be able to tell a story of how the last 3 to 5 years of the company look like, right? Because the next step you're going to do is you're going to forecast future performance for the company. So when you're doing this analysis, you'll have to have a good knowledge of where the company is at and where is it coming from. Let's look at 2 groups of ratios. DuPont analysis is, we're going to start from right to left. So if you look at the 2 ratios on the right, remember I told you there's 2 basic ways of making money. Getting a profit per transaction, and then getting as many transactions as possible. Getting as many transactions as possible is on the asset turnover side. And the net profit margin is looking at the profitability per dollar of revenue. So if you get these 2 guys together, you're looking at how many cents does the company sell per dollar invested in assets? And out of those dollars that the company sold, how many cents are left out for shareholders to collect at the end of the year, right? So this is saying how efficient is the company in translating investment in assets into revenue? And how well does the company manages its margins to get as many cents as possible per dollar of revenue? Those are the basic two ways in which companies make money. Sell as much as you can per dollar invested, and make as much profit as possible per dollar sold. Okay? And this is what these two guys are doing. So if you multiply one by the other, you get what's usually called the return on assets, which is, or you're going to cross revenue here, and you're going to end up with net income divided by total assets. Net income divided by total assets, it's telling us how many cents is the company generating in revenue, in profit for shareholders per dollar invested in assets. The higher, the better. However, we understand that these assets, companies within the same industry could finance those assets in completely different ways. They could have 100% equity, or it could have a mix of equity and debt. So that's why we multiply return on assets times the equity multiplier to get the return on income. Equity multiplier is, we saw it before, assets divided by equity. So if you multiply these two ratios, you cross the total assets and you end up having net income divided by equity, which is your return on equity. What does return on equity tell us? It's telling us how many cents we are giving shareholders at the end of the year per dollar of equity invested in the firm. The higher, the better. So this is how the DuPont tree is summarized in a equation. I will just move forward to show you. I'm going to skip the limitations. I don't think we're going to have time for that. I just want to show you an alternative way of doing this. And now we're going to start from the center to the left. So ROIC tree, instead of doing net income, which is a measure of profit to shareholders, this is only looking at the operations level. So instead of using net income, it's using earnings before interest, taxes, and amortization. And it's dividing that by revenue. So it's doing an EBITDA margin. How many cents is the company generating in EBITDA per dollar of revenue? And then multiplying that by capital turnover. And that capital turnover is revenue divided by total invested capital. And we'll come back to that definition of invested capital in upcoming lectures. When you multiply those two, you get the return on invested capital, which is an operating measure of profitability. And it is a measure that you will compare to see if the firm is doing okay or not with your weighted average cost of capital, WACC. So this ROIC, you will always compare with your WACC to see if the company is doing as investors are expecting. I will very quickly ask you a few questions, and then you're going to be free to go. Oh, you're free to go at any time. So let's do this very quickly. 2.5 minutes. 10 seconds. All right, we're starting now. So I'm going to stop in 20 seconds for the next questions. All right, skipping to the next one. You got 20 seconds. Five seconds. Gone. Two more. You got 20 seconds. Ten seconds. Gone. Remember, you only have 20 seconds. Two seconds. Who wins? You are? All right. I'll give you the team times on my way out. Thank you very much. I'll see you next Friday. Have a good weekend. Well done. Cheers.